Then they take your monthly payments of your mortgage bill plus all your monthly payments on your credit report, car loans, student loans, minimum credit card payments. They don't care about insurances and utilities and stuff like that. Only what's on your credit report. They take all the minimum payments, they add it to what your mortgage payment's going to be with taxes and insurance. That's your in or your debt. Then they divide that by your income. And if you're going to get a conventional loan, you have to be under 50% debt to income ratio on a monthly cash flow basis. If you're 49.999, you pass. You're going to get the loan. If you're 50.001, you're not going to get the automated underwriting approval through Fannie Mae or Freddie Mac. You're not getting the loan. I mean, there's been times where I've called insurance agents to drop their annual insurance policy by $5 a year, to drop the payment by 50 cents, to get them to 49.999% debt to income ratio to get an automatic underwriting approval. And the cool
Wow.
thing is that, most brokers like myself, I run the exact identical Fannie Mae and Freddie Mac automated underwriting software before I send it to the lender. So when we're submitting a loan to a lender, we're not, I hope it's
Okay.
approved.
Yeah.
We know for a fact that we have the automated underwriting approval through Fannie Mae and Freddie Mac, and that underwriter at the lender I'm sending your loan to is going to run the exact identical same stuff. And if I calculated your income exactly adhering to Fannie Mae and Freddie Mac's rules of calculating income, then the underwriter that gets it is going to calculate to the dollar the exact same income, and we're not going to have debt to income ratios because we knew this before you made the offer on the house. And
Wow.
so what happens is most people is there when they're qualifying for a house is I'll calculate their debt to income ratio, and the biggest thing is I want to know how much I approve for. Well, you'll be approved at 49.999%. On FHA guideline is 57. So you can go to 56.999 FHA. I think they raised that a little bit because they're jacking you on the upfront funding fee, and they're
Sure.
adding higher mortgage insurance, so they're going to give you a little leeway there. But there's a finite number of what your debt to income ratio needs to be to get the loan. I'm Most of the time, 80% of the time, I'll have somebody, maybe they have a $100,000 salary, so they make, $8,300 a year once you take it down to the monthly, and maybe they have a $500 car payment, so half of $8,300 is, 4,150. They got the $500 car payment, they qualify for a $3,600 mortgage. That puts them in at 49.999. And they say to me, I don't want a $3,500 mortgage payment. And I say, well, many times people qualify for more than what they would be willing to spend. So then it comes down to let's reverse engineer your debt to income ratio, and let's find out what's your walk away monthly payment. Like if that house is perfect, but the payment's $3,700, I don't care how perfect it is, I'm not getting into a $3,700 payment. I don't want anything higher than $2,800 out here from a first time. And you say, okay, what if the payment's 2,850? Well, I mean that'd be okay. Okay, well, what if it's 2,900? Well, I mean if it's the right house, what is the payment have to be to make you walk away and not make an offer on the house? Like, what's your walk away payment?
Yeah.
Because at the end of the day, when you're buying a house, especially for first time home buyers, there's a lot of things involved. You get excited, you're buying a house, but
Yeah. A lot of emotions.
once you close and you take the pictures and you call your parents and you have your friends over, 45 days later after closing, mailman brings you your mortgage bill and you're going to have to pay the bill. So it's all about what that bill's going to be. Let's qualify around that because most of the time people qualify for a much higher bill than they're going to feel comfortable for. But the point is that after you close, you got a mortgage bill to pay. And
Yeah.
so that's why I really like to focus on. That's why I love being a broker because I know I'm always the lowest rate because I know what people want. They want the lowest mortgage payment they can get on the house they want to buy, period. And that's
Of
what I
course.
want. When I buy a house, I want the lowest mortgage bill. And
Yeah.
so let's try to craft your approval I might send you back to your realtor saying, "Hey, I'm approved to 600,000. I can buy a $600,000 house, but I don't want to be over 450 because I don't want my payment to be over 3150 or whatever that number
Sure.
is." But the bottom line is that we when we get to that number, we will know that we're going to have an automated underwriting approval through Fannie Mae and Freddie Mac. So when we get to once you get the contract, you already know what the payment's going to be at the end of the day. Like
Hmm.
we've done all that. I have all your pay stubs and the things that I need to calculate your income. I've seen your credit. I know what's on there. There's no mystery. We're not going into underwriting hoping and praying that our loan gets approved. We're going into underwriting with the dominoes already set up as a formality to close on the house. And that takes the stress away. It takes the anxiety away because they were educated up front of what an automated underwriting approval is, what it takes to get an automated underwriting approval, whether or not it's going to Fannie Mae or Freddie Mac or FHA or VA. They know that we've laid all the loan programs that are available to them on the table, and we've looked at them carefully as far as what's going to end you at the end of the day with the lowest mortgage payment, because
Yeah.
that's what people want. And and
Yeah.
and how can we get into that with paying the least amount of fees? Let's make it cheap. We're
Right.
going to make the cheapest loans that fit your budget, and you're not going to worry about whether or not it gets approved because we put the underwriter hat on at the beginning of the process before you even look at a house and write an offer. And so half of my job is underwriting. So a
Yeah.
good loan officer,
Yeah.
they're going to underwrite up front. And then the other half of the job is the day trader. And that's going to be another podcast. We're not going to get into that now, but
Yeah. No.
we're going to lift the veil of mortgage pricing and how rates change and what affects the change in rates and what affects those different, why
Yeah.
do why does a 7% cost this and what are the fees on that? And we'll do all the fees and that because once I get somebody approved and they make an offer and they're in contract, then it comes down to, okay, now let's sharpen the pencil and really search the market, put our day trader hat on, and lock a rate when the price is low.
Yeah.
And then they can feel comfortable about that. And what you were saying earlier, Gary, I thought was a really good point. Like the appraiser shows up and they're like, "What's going on?" That's another thing people aren't educated in, and it's really very simple. When you're buying a house, there's four times you're going to write a check. And you're going to write a check when you get into contract because you're going to have what's called earnest money. And
Yep.
that's like the money that you're putting down to hold your contract. And that's typically about 1% of the purchase price. And that does go to your 3% or 5% or
Right.
3.5% down payment. So that is part of your down payment. But that's the first check you write. The second check you write is once you drop your earnest money off, you got to get an inspector. That inspector is for you. It's not for the bank, but you got to pay him because you want to make sure the house doesn't have black mold, it doesn't have foundation issues,
Yep.
whether or not it needs a new roof. You got to make sure that you want to move forward with this $500,000 purchase. And then the
Sure.
third check you write is that once you've done your inspection, maybe you go back and get some credits or you get the seller to paint the railing or whatever it is. Then you're like, all right, we're moving forward. Then you write the check for the appraiser, and that's when Gary
Yep.
comes in because then
Yeah.
you get employed by the lenders and they call out to this random wheel called the AMC or the appraisal management
Yep.
company, and then you get assigned the deal after the check is paid, and then you got your money and you go out, and that check is not for the buyer. That check is for the lender.
For the
So
lender. Yeah.
the first check you write is a down payment on your down payment. The
Yep.
second check you write is to make sure you want to buy the house and it's not going to fall down. The third
Yeah.
check you write is for the bank because the bank wants to know that the house is worth what you're
It's a good
paying.
deal.
And then the last check you write is finally on the day you close, you bring in the rest of your down payment and whatever closing costs you're responsible for. And when they know that, they're like, oh, well, then when the appraiser gets called, they're like, oh, yeah, well, I know that. Yeah, I did my inspection. Now it's the appraisal. And next
Yeah.
it's my third check to write. And I don't have to pay anything till we close. And it's just, it brings the stress level down of buying a house because there's plenty of stress in buying the house, furnishing it,
Yeah.
and moving, and all this stuff.
Yeah. Roland, as
You really laid it out and really educated a lot, even myself, because I never really knew the full in depth of your side of the ball, and and I think this is unique and it's important why it is for refinance buyers to educate themselves and not to be afraid to go to those smaller individual mom and pop shops, because they're the ones that, like yourself, that really are going to steer that person the right way.